What's up everyone, my name is Ale. Welcome back to the channel. So as I've told you guys before, I'm planning on adding new types of content and series to the channel. All of the original stuff that you're already used to and that you enjoy, none of that is going away. Everything is staying the same. I'm only going to be sprinkling in additional types of videos as we make our way through the year, just to keep things fresh and more engaging and kind of fun and entertaining. And one of the ways to better engage with you guys is to answer some of your questions, which is why I'm introducing this brand new series today called Ask Ale, where I do exactly that. I answer your guys' questions, and today is going to be episode number 1. Now, to get your questions featured on these episodes, all you got to do is drop a comment in literally this video or any other video you want. Just leave a question for me. I read through all of the comments. I don't always have time to respond to all the comments or leave really detailed responses. I try to, but I don't always have that time. So these episodes will be great because it'll give me a chance to give you guys bigger, more detailed responses to your questions. Now, I will usually be answering multiple questions in these videos and try to give kind of shorter responses to them. But in today's episode, we're only going to focus on one very large question, and I'm going to go a little more in detail with it. And that is just to kind of keep things simple because it's the first episode and I just want to keep things simple. In the future, I'll answer multiple questions, and the questions can be about anything. You can ask me personal questions. You can ask me about any stock that you're interested in and you want my opinion on it. Literally anything. It could be educational, whatever you want. Leave your question, and usually the more popular ones or the ones that get asked more frequently, I'll probably answer those kind of in order that way. But anyway, for today's episode, this is a question I get asked a lot of times, and that is, what is the best stock market strategy for success, and what do I use myself, and do I have any tips or advice for anyone that is new to stock market investing? Well, the way I see it, there's really three large kind of primary strategies that then branch out into smaller ones, but those primary ones are typically short-term trading, long-term investing, and I would also add in their dividend investing as well. Now, as the name implies, short-term trading has to do with making short-term moves in a stock in order to make a quick profit. And so you're not really interested so much in the company's long-term success. You're not looking at all of their financials. Typically, you're not going to be studying all their products and services and their competition. You're not like a part owner of the company. You're not really an investor. You're just a trader. So you're a short-term trader. You're just trading stocks back and forth. So you're only really playing with the stock price itself, trying to make a profit. So the time frame is usually pretty short. So typically, it can go up to like maybe a year that you're holding a stock, but usually short-term traders are moving in and out of stocks within months, weeks, days, or sometimes even literally just minutes and seconds if you're like a day trader and you're just kind of making frequent trades. Now, the pros of this is that you can make a lot of money very quickly. And that's why a lot of times you hear of like day traders doing this as a profession, right? Some people are like literally consider themselves professional day traders. It's all they do all day is just kind of moving in and out of stocks, trying to maximize how many times they can make trades in order to maximize their opportunities for profits. But the cons of short-term trading is that it is easily the most risky strategy out there because it has everything to do with timing the market and timing stocks, which we all pretty much, or I would say a lot of us agree that timing the market and timing stocks is extremely difficult, if not impossible, but we would say at least extremely difficult. And so most of the time, people do fail with this strategy and end up losing money because they can't do it consistently. There's a lot of people that do short-term trading that find some success initially, but a lot of that has to do with beginner's luck. It just, there's a lot of luck involved sometimes, and they can't seem to replicate it consistently over a longer period of time. So if they keep playing around with it, eventually, a lot of times they do end up losing money. I have a lot of friends and family that have talked to me about short-term trading. They fell in love with it initially. So maybe within like a month, they had a lot of success with it and they got really excited. But then over time, they tried to replicate what they were doing with other stocks, and they would go heavier and heavier on other stocks because they felt, well, I had so much success trading this stock in just a short period of time, I can probably do it with a bunch of other stocks. And they would go in much heavier because they were going in with that newly found confidence. And they would go heavy into a stock, and then they would make a wrong prediction, right? Because it's difficult. You're trying to time stocks. It's very difficult. In the short term, it's very difficult. So they would make a wrong prediction. A stock would go down, and then they would panic and sell because they never actually liked the company or had a long-term vision of the stock to begin with. They were just looking to make a quick profit. So they never intended to hold on to that stock long term. So as soon as you get a wrong prediction, you think a stock is going to go up, and maybe you just put in $10,000 thinking it's going to go up. All of a sudden, that stock drops 20%. You start to really panic. Then it drops 30%, 40%. Then you're really panicking. And then what do? A lot of times they'll sell out of it because they never wanted to own that stock to begin with. That, again, that's not always the case. I do know some short-term traders that have had success. One of my uncles has had success, from what he tells me, pretty consistently. So I do know some people that have had success with it. And there are ways that you can actually increase your chances of success depending on the tools and strategies you use within short-term trading. So you can use things like technical analysis, which is basically looking for patterns in the stock price, and you're trying to kind of trade that stock based off of those patterns, based off that momentum. And so if you're using technical analysis, sometimes you can kind of lower your risk a little bit. But even then, you're competing against some really rich hedge funds that have some really expensive programs and algorithms that are going head up against you. And if it was so easy to be a successful short-term trader, even with technical analysis and algorithms and stuff like that, then the richest people in the world would be short-term traders. And of course, we know that that's not the case. Richest people in the world are actually long-term investors. So people like Warren Buffett, or even company owners who held on to their stock long-term, like Jeff Bezos, Elon Musk, stuff like that. So I'm not saying short-term trading can't be used successfully. I'm just saying that it's very difficult. And I usually don't recommend it for the average person, because the average person will lose money. Now, you could use a couple other things within short-term trading, things like swing trading, which I've actually used on occasion myself. Pretty rarely. I don't consistently use it or usually use it. But on occasion, a rare occasion, I have used it in the past, and it can be successful. Swing trading is basically when you notice that a stock is very volatile, and it's usually trading up and down within a certain range. So think of stocks like maybe Tesla, maybe NIO, right? The Chinese kind of version of Tesla, very volatile stocks. And there were some pretty long time periods where they would trade within a range, and it would just go up and down, up and down, up and down. So if you bought it on the lower end of that range and sold it at the higher end and just kind of rinse and repeated, then you had a lot of success. And I remember a lot of people would leave comments, and a lot of friends and family would tell me, yeah, I keep swing trading these stocks and I'm having a lot of success. People do it a lot with cryptocurrencies too, did it a lot with like Bitcoin, stuff like that. But the problem is eventually you get to a point where you make a wrong prediction and it kind of breaks the trend or something, and then you have to be careful. So some of these strategies can be effective. Of course, you can also add in options. Options can actually be used by long-term investors as well, but I like to think of options as more of a short-term trader's game, just because you are still kind of making predictions. Basically, the way options work is you're making a prediction on whether a stock will go up or down by a certain amount and by a certain time, right? Like within a certain time period. So you're still kind of making those short-term predictions. Now, you could have longer options, and that's where you can lower your risk a lot, because if you increase the time frame, you can lower your risk a lot, but you also lower your reward potential, because if you increase a time limit, you say basically, I think stock A is going to go from $10 to $20. Well, if you think that's going to happen within a week, your reward potential is very high with options. If you say that's going to happen within a couple of years, then your reward goes down a lot, because obviously that's a much more reasonable time frame for a stock to double or something like that, right? So, but a lot of that has to do with making predictions, has to do with playing around with the stock price itself. So a lot of that stuff tends to be more on the short-term kind of traders side. Again, options is a little different because it is often used by long-term investors as well. But typically short-term trading, I usually stay away from that, and I usually stick with long-term investing, which is my core foundational strategy. Now, before I move on to that strategy, I just want to say, if you really insist on short-term trading, one of the best ways to be a short-term trader, but to dramatically lower your risk, is to actually combine it with long-term investing. And I'll show you exactly how to do that in just a second. We'll go into that. But first, let me just quickly cover long-term investing, and then I'll show you how I've even included some short-term trading into my long-term investing strategy, and I found that I was able to dramatically lower my risk and increase my reward potential. So I'll show you that in just a second. But with long-term investing here, this is what I do recommend for the average person, especially beginner in the stock market. Usually you will have success in long-term investing as long as you follow some basic principles, and that is to have a long-term strategy where you're basically going to be holding stocks for years. Okay, so this isn't going to be months or weeks or even days or whatever. This is years. Typically, long-term investing, we consider it 5 to 10 years. That's kind of the throw around time frame that people like to use. But I would say even more than that, because, and especially if you're younger. I understand if you're older. But for me, I've always thought about holding stocks for literally decades if possible. And at least that's initially my thought. Now, that can change later on. A company might perform differently and things can change in my investing thesis. So maybe I'll adjust that later on. But initially, when I first pick up a stock, I'm usually thinking decades. Not all the time, but a lot of times I like to do that. And that will set you up for success if it's the right company. Which brings me to the other point here. You have to put in a lot of work. Now, this is an easier strategy than short-term trading, but easier in the sense that the risk is a lot lower, but not easier in the sense like that it's less work. It's actually, if anything, it's more work, but or maybe just the same, whatever. It depends on your opinion, but it's a lot of work. My point is, with long-term investing, you have to research the company, research their financials, know how they're performing, stay up to date with it, reading through all of their earnings reports, watching their presentations, know about all of their products and services. Ideally, you would even be using their products and services. Those are the best companies to invest in because you understand them a lot more because you're one of their customers. You have to understand their competitors. You have to understand the market that they operate in. You have to research all of these different things. You have to look at the valuation of the stock, right? You got to look at the fundamentals. Look at the valuation of the stock. Look at their balance sheet, but make sure you're paying a fair price for the stock for what you're getting in return, because now you're thinking long term. You're not just trading here based on momentum. Now prices really matter. Valuation matters even more so. And so you want to make sure you're paying a fair price for what you get in return. You got to have some growth there. You got to have growth potential, got to have solid, profitability, ideally. So you need to do all of that research. Now, with long-term investing, you should also diversify your portfolio. That's something that I highly recommend because you don't want to have all your eggs in one basket. You would like to ideally own multiple stocks, and you want to have a combination of maybe some value stocks, some growth stocks, some stocks in different sectors, right? Companies doing different things. And you could also throw in some dividend stocks in there as well, which is the third strategy that we said are of the three primary strategies. But the reason I include it here is because dividend investing complements long-term investing very well. They both complement each other very well because if you're a dividend investor, and dividends are basically just payments that a company will give you just for owning the stock. So you own, let's say, Apple stock. Okay, Apple does pay a very tiny dividend, but they pay one. So you own Apple stock. Apple will literally pay you every quarter. So basically 4 times a year, they'll pay you a dividend. They'll make a payment to you just for owning the stock. And the reason why it goes very well with long-term investing is because this is a consistent source of cash flow for you. So this is a consistent paycheck that you can collect. You would ideally like to keep collecting this for as long as possible and maybe even into retirement. So if it's a good company, these are things you have to research, right? You got to research that it's a good company, reliable company. Got to look at their dividends. Have they been paying dividends for many years? And not just paying them, but have they been growing their dividends every year? Because that also shows strength in their financials and in their willingness to pay dividends. I mean, there's companies that have increased their dividends every year for literally decades and even through recessions. So wouldn't it be nice to own some stocks during a recession that is actually paying you money? I mean, that's incredible, right? That's a great thing because during a recession, you might be struggling. Well, you're actually still collecting some cash flow from your dividend stocks, assuming it's a good company and they're able to pay those dividends through even a recession. So the two go hand in hand. Long-term investing, dividend investing complement each other very well. I would argue that you can get better returns on your money from just stock price appreciation, meaning just the stock price going up, but dividends is a nice way of kind of diversifying, and it's a nice complement to your overall portfolio. Now, I mentioned that if you are going to be short-term trading, you can dramatically lower your risk by combining it with long-term investing. And so what do I mean by that? This is like a nice little secret here. I'm going to give you some secrets here. Not really secrets, but at least for me, these are kind of the keys to my success, is that I do everything within long-term investing, and that's how I've dramatically lowered my risk and how I've held on to stocks that have gone up by so much over time. When people look at my portfolio, they're always surprised at how much I'm up on every single stock. It's like usually rare that I'm down on a stock. And there's a few reasons for that. Let me just quickly say this before we get into the short-term trading stuff. Whenever a stock, this is a huge, if I could give you like one, like the most important piece of advice here is to do this. Buy stocks when they're going down and make sure that you have enough cash on the side to add more to your position. So the more that it falls, the more you can add to it. And I know this sounds very simple, like, oh, okay, well, you're basically just saying be rich, right? You're basically saying be rich. Like if you have money, it's very hard to be unsuccessful in the stock market if you have money, because a stock goes down, assuming you did all the hard work, assuming you chose good companies, the stock price goes down, that's a buying opportunity, right? You liked it at $100, you should love it at $50. So all you need is more money so that you can buy at the lower prices, and then it should eventually recover. Again, assuming you did your homework and these are good companies that will recover and be successful long term. Think of something like Amazon, for example, right? We all know Amazon is going to continue to dominate and they're going to be even bigger in the future. And that's especially been the case the last few years, right? We should have all been buying Amazon stock, which I was, but all of us, everybody should have been buying Amazon stock in the past decade, right? But there were many times where Amazon stock went down, many times, and people were panicking and freaking out, and those were all huge buying opportunities. So if you had the money, you could have doubled down, tripled down, quadrupled down, keep adding more and more and more to that position, and then when Amazon recovered and it took off and started trading at record highs, you made a ton of money. Okay, so you're gonna say, well, you're basically just saying be rich. Yes, but there's actually a way that you can do that where you don't have to necessarily be rich. You can still use this strategy. All you have to do, pick up Robinhood, the app, right? And I'm not sponsored by them, but use Robinhood. You can buy fractional shares. So just know what your budget is. And with fractional shares, you can literally buy a stock worth only $1. So if there's Amazon stock, right? Amazon trades for thousands of dollars. So you say, well, I can't have enough money on the side to buy Amazon stock when it trades for thousands of dollars and then double, triple, and quadruple my position as it goes down. I don't have that kind of money. But with fractional shares, you can do that because you can buy just literally whatever your budget is. You can buy $1 worth of Amazon stock. It goes down, okay, double your position, $2. It goes down again, okay, double it again, $4. You're telling me you can't afford $4? So whatever your budget is, just try to figure that out and use fractional shares, right? I'm going to the extreme by saying $1, but you can, maybe you do $100, right? Maybe that's a reasonable purchase where you can consistently, spend $100 on a stock, maybe once every few days or once a week or whatever, right? So just make sure that your spending goes in line with your budget, and you can do that with fractional shares. And if you do that, you're going to have so much success because then stock prices going down never hurts you. You're going to always want stock prices to go down if you have the budget to buy more. So I always want stock prices to go down, and people always respond to me in the comment section, why do you want stock prices to go down? That's a horrible thing. No, it's not for me, because I have cash on the sidelines. I always make sure I have enough cash on the sidelines, so I always want stock prices to go down so I can buy more. Okay, sorry, I went off on a rant and I probably repeated myself over and over, but I'm just saying that's the biggest piece of advice. That's what I always tell my friends and family. I always say, make sure that you can buy stocks when they're going down. If you can't do that, you're going to struggle in the stock market. It's going to be hard. Anyway, now with short-term trading implemented into long-term investing, what I mean by that is if you have to gamble on a stock, you have to short-term trade it. You think, man, this is such a great opportunity within the next couple of weeks. They're going to release a product or something that I'm super excited for. And maybe I don't know everything about the company, but I just really want to buy it. Or maybe it's a very risky stock. Maybe it's a company that is not profitable, but you really just want to take a chance on it. Okay, if you're going to gamble on stocks, then at least gamble on companies that you believe in, on stocks that you believe in long term, so that if things go bad, at least you can just hold that stock long term. So I never gamble on random stocks. Like when a friend tells me, hey, the stock is going to jump up a huge amount, I don't just go out and buy it. Okay, I could do that, and some traders do that, and they take huge risks like that. I'm not going to take that risk. I'll own a stock, I'll buy a stock, and maybe I just kind of want to make a quick profit on it. But it has to be a company that I still believe in long term, because if things go down and it drops 50%, okay, I can still hold it over the next decade or so, and it's not going to hurt me, or it's a company that I believe in. So only gamble on companies you believe in. Only gamble on stocks that you can hold long term. So maybe the best example for this would be swing trading. If you're gonna swing trade on a stock you believe in long term. For me, I always believed in Tesla stock, right? And I saw Tesla being super volatile. So there were actually times where I swing traded Tesla stock. And the reason why was because if I got a prediction wrong, if I bought it at, I don't know, 500, and it dropped to, and I thought it was going to go up to 600, but it actually dropped to 400. That's okay, because I love Tesla stock. I believe in them long term, so I can just hold it long term. So maybe out of a company and a stock that you believe in long term, maybe you buy 80% of it, and maybe 80% of that position you just hold very long term. You say, I'm not going to touch it, I'm just going to hold it long term. But maybe the other 20% or 10% you kind of play around with in the short term. And worst case scenario, worst case scenario, the stock goes down and you hold it long term. So I don't know, I might not be doing the best job of explaining this, but my only point is, I rarely short-term trade. I rarely use short-term trading strategies, but when I do, it's always on companies that I do not mind holding long-term. It's always stocks that I do not mind holding for many years, so that I can actually wait for them to recover. And that dramatically lowers my risk. Anyway, that's going to do it for this video, guys. I hope you enjoyed it. We probably went a little too long here, but leave your comments and questions down below. I'll try to feature them in future videos. And just to kind of summarize, long-term investing, I think that's the best strategy, but make sure you do your homework and stick within those principles, and you'll be fine long-term. Stock market usually goes up long-term unless there's some catastrophic, horrible event, which we're not going to see coming anyway, because it's hard to predict. But anyway, hope you guys enjoyed the video. I will catch you guys in the next one. Take care. Bye-bye.